Good morning and welcome back to Financial Accounting. Last week, as you know, we had virtual class where you were asked to watch the recordings from last semester's classes while I was away from campus. So hopefully if you do have questions on that you're not asking during class, that you schedule time with me to talk about any questions, issues outside of class. If it would be helpful, we can always schedule a kind of a review session outside of class time as well. If we need to, if there are lots of people, if there's multiple people who want to go over those exercises live, I would be happy to schedule a review session either Wednesday, Thursday, Friday this week. Because as someone pointed out before I started the recording, our first exam for the semester is coming up, and that is actually due this coming Sunday. So let's take a look at that exam. That's where we're going to start today. Just need to get to it here. It might be on page 2. So the exam is available for you now. I strongly recommend, of course, that you finish all of the assignments for chapters 1, 2, and 3 before you attempt the exam. The exam covers those 3 chapters. So we should be finishing chapter 3 today during class, if all goes well. And the chapter 3 exercises would be due tonight. The problem would be due on Thursday. And once you finish that problem, you should be ready to take the exam. As I told you the first week of class, for each exam, there is also a practice set. And so when you are in Cengage, that practice set of exercises does not show up on the page that says assignments I can take now, because it's not graded. So you need to switch. There are 3 different options: assignments I can practice now, assignments I can take now, and all assignments. So you want to be on the one that either says assignments I can practice now or all assignments. I believe the default is to assignments I can take now, and it will not show up there at all, because it's not graded. So this practice set is optional, but it is the exercises that I put into this practice set. I put there for a reason, and that's because there's something similar to this on the actual exam. So if you are, especially if you're feeling like maybe I'm not ready for this, working on these practice exercises would be very helpful for you to boost your confidence, to help you refresh on information that we covered in chapter 1, which was a few weeks ago now. Many of the exercises that are in this set also have the show me how option, as well as the check my work option. So up here at the top of the screen, you can see that show me how link, which will give you more assistance than just using the check my work button. As always, if you're working on this and you get stuck on something and you have a question, I would be happy to help you with that. As I've said, I'm happy to help you with anything other than the exams while you're taking the exam. So please just ask for help. You can ask by email. I have a few students, mostly in the online class, who are using this email instructor button, and that seems to be working out pretty well because it sends me exactly what you're working on. And that does actually allow me to reply to you, unlike if you send me an email through Brightspace and I can't reply, as we've discussed. So I encourage you to use that email instructor button. It does work, and it does come to me. And sometimes it's even big enough that I can see it on my phone. Usually I have to get to a computer because it gives me kind of a screenshot of what you're working on. So you do have exercises here from chapter 1, 2, and 3 that are similar to exercises that you will see in the exam. So I do encourage you to try that practice set first. Then the exam. So the exam, as you can see, the exam is timed. So this is the only assignment for the semester. The exams are the only assignment that there is a time limit. If you've provided, God bless you, If you have provided me with an accommodation letter, I will build that extra time right into Cengage. If you do click on the exam and it doesn't show you that extra time, please email me. Don't just start the exam. Let me know, because it may be that it just didn't save the way I think it's supposed to. And I know it works in CNOW, but I don't do it that often. And so I'm always afraid that it doesn't work properly. So please don't just start the assignment. If you don't have the extra time that you need to have, then let me know and I can fix that for you before you start. Once you start, it gets a little bit more complicated to change that. And so you can see on the exam, this exam has a total of 30 questions, and it is a mix of multiple choice questions and exercises similar to what we do in class and to what you see in that practice set. For the most part, the multiple choice questions, I expect that if you are prepared for the exam, that you can read the question and choose the answer. So they're not supposed to be trick questions. They're supposed to be content that is already familiar to you. I also need to remind you that you are expected, you are allowed and expected to use the textbook during the exam. It is open book, open notes. You can use any of the materials that I provided for you. The only thing that is not allowed is to work with someone else or to have someone else do the work for you. Everything that we have done during class, if you have printouts of exercises, of problems, of the quizzes, I don't know why you do that, but anything that you have, if you've taken notes during class, those are expected that you're using those as your resources. There is a time limit, as I said, on the exam. The time limit is 3 hours, which is plenty of time to do 30 questions. 3 hours is plenty of time to do the 30 questions, unless you try to look up every single answer, in which case you could run out of time. And certainly some of the work is not information that can be looked up, like the exercises, which require you to work on them. So the exercises look something like this, where you're asked to journalize the entries to correct errors made in the accounting information system, or journalize these adjusting entries like we're doing now in chapter 3, and you should have started on your own this past week while I wasn't here, or journalize the payment of payroll, prepare an income statement, stockholders' equity, and balance sheet. So that's from chapter 1. I will also give you a hint. I imagine you've probably already noticed this. All of the numbering of our exercises that we do in the chapter, it starts with a 2-digit number, like 01, 02, 03. That's the chapter number. So if you look at this exercise, you can see it's 02.93. So that tells you this is something that we covered in chapter 2. So if you do need to look something up, just as a reminder, how do I do that again? This is giving you a bit of a hint about where to start looking. So again, as I've said, the very beginning of the semester, there's not what's on the exam is not supposed to be secret. I'm showing you some of it, jumping around, showing you some of those questions. They're not, it is not intended to be any kind of a trick question. It is a way for me to evaluate how you're doing in the class, and also to give yourself feedback about how you're doing. Once you submit the exam, it will tell you what your grade is immediately, just like on the quizzes and the exercises and the problems as well. And then as soon as the time period for taking the exam has passed, you can go back into your exam and see everything that you missed. What did you say the answer was? What was the correct answer? And once the exam period has passed, if you have questions, I'm happy to go over anything with you. I generally don't go over them in class because most people don't have the same questions. But I am more than happy to talk about individually with anyone. Something that you missed on the exam or something that you found more difficult. So Patty, you're the one who asked the question. Is that you comfortable with how the exam is structured? Any other questions you want me to talk about related to the exam? Okay. So the exam, as I said, you should be finishing all of the work from chapters 1, 2, and 3 before you take the exam, just to make sure that you're prepared. You know, it is, as I said, it's a way of for me to evaluate how you're doing. Well, it's not reasonable to expect that you will do well if you haven't done all of the preliminary work to prepare for the exam. That does not include the practice set. That is totally optional. But you definitely should have done all the work for chapters 1, 2, and 3 before you take the exam. The exam time limit is 3 hours. I think I already said that. Once you start the exam, you cannot pause it and come back to it later. That 3 hours, once you start, that 3 hours starts running and it will submit automatically at the end of that 3 hours, even if you're no longer on your computer. If something happens, if you accidentally submit the exam or I can reopen it for you within that time period. If you accidentally click on the exam, but you didn't mean to start it, send me an email immediately. I can delete your attempt and you can start it when you had planned to start it. So, you know, things like that happen. Usually there's someone every semester who accidentally clicks on the exam and I can fix it, but you have to tell me that it happened, okay? And tell me right away. Don't wait until next Tuesday's class and say, oh yeah, by the way, I didn't take the exam because I accidentally clicked on it on Thursday night as I was falling asleep at my keyboard or whatever. So make sure you let me know by email right away and I will help as soon as I can. Okay, so questions. The exam period, as indicated on your syllabus, is Thursday through Sunday. So it's always a 4-day window. All of them will be Thursday through Sunday, except the very last exam because the semester's ending and we don't have a Thursday through Sunday after we finish chapter 14. So Thursday through Sunday, you can take it Thursday after class, before class if you want. You can take it Sunday night if you want. Bills don't play till Monday, so you should be clear on Sunday night unless you're a fan of one of those really bad teams that are not the Bills. It matters not. Please don't email me and say, can I start it at 11 p.m. on Sunday and then your time would go to 1 a.m. on Monday. That's okay. It will still allow you to do that. You don't need special permission, but it needs to be finished by Sunday so that I can take a look at how people did and before we come to class on Tuesday. So I think at this point, we're ready to jump into the end of chapter 3, but is there anyone who wants to ask a question, clarify something, anything else? They're really the same thing. Accrued income. Yeah, that would be the same thing. So, and I'm going to give a brief definition of what it means to accrue something as we get started. So, but if you see those two, accrued income would be an unusual term. We'll normally call it unearned revenues, but it really is the same thing. So an accrual means that you are pulling something into the current period where the cash might not change hands until the future, or we might not meet our obligation until the future. So let me step back and talk about something you should have seen in the video already, but because I wasn't physically here to say it to you. I want to make sure everybody's clear on that. What we're discussing in this whole chapter 3 is really the difference between cash basis accounting and accrual accounting. Accrual accounting is what is required under GAAP. The whole reason we do what we're doing in chapter 3 is so that people looking at our company, at our financial statements, have the true picture, a faithful representation of what's happening in our company. And so for any given accounting period, whether it's a month, a quarter, a year, we want to show on the income statement the revenues that we have earned in that period. That is, we performed the service, we delivered the product that our customers are buying from us. So those are the revenues that we've earned. But it might be that our customers pay us before we've earned the revenues, that is, we haven't performed the service or delivered the product. And so that's when we would have unearned revenues. Our customer paid us, but we haven't held up our end of the deal yet. So that would be the unearned revenues. Accrued income would be that I know I said it's the same thing. From an accrual accounting standpoint, it's the same concept, which is the cash changes hands in a different period than we earn the revenues. And so if we accrue income, it means we've earned it, but maybe our customer hasn't paid us yet. So I may have misled you a little bit when I said they're the same thing. I'm thinking from an accrual accounting standpoint, the concept is we record revenues when we've earned them, regardless of whether our customer has paid us. Sometimes the customer might pay us early, and sometimes the customer might pay us later. Either way, the revenues need to be recorded when we actually finish performing the service or delivering them the product. Does that make sense? So in accrual accounting, we record revenues when we've earned them. How do we know if we've earned them? Well, there's a 4-step test that the SEC has set up for us. We have to have delivered the product or performed the service. We have to have an agreement between the buyer and the seller. We have to have a price that's fixed or determinable. And we have to have reasonable assurance of collectability. So if all 4 of those things are true, if all 4 of those things have happened, then we need to record the revenues in the period that the 4th one, the last one, is in place. Okay. Once we've recorded the revenues that we've earned, then we need to match against them the expenses or the costs that helped us to generate those revenues. Again, so that our income statement fairly accurately represents what really is happening inside our company. And I've given you an example in an earlier chapter when we talked about things like prepaid rent or prepaid insurance. If you pay 6 months of an insurance policy all at once, if you record all 6 months worth of expense in 1 month, and then the next 5 months, we don't record any expense at all, it's going to make us look worse than we are in that first month, and then better than we are in the next 5 months. So the whole concept of accrual accounting and the matching principle is that we want our income statement to show how we're really doing. Because as you know from chapter 1, the whole point of doing this stuff is that we're helping decision makers make decisions about our company. And so we need to make sure the information we provide to them gives them what they need to make a decision. It needs to be faithfully representing, accurately portraying how we're doing. So we don't want to show revenues we haven't earned yet. We don't want to show expenses that we haven't really incurred yet, regardless of when the cash changes hands. And so the exercises that you should have already completed on your own from Thursday's virtual class, we had classifying accrued revenues and expenses, unearned revenues and prepaid expenses. All of these are examples of the cash changing hands in a different period than when we record the revenue or expense. In exercise 2, you are asked to consider what would happen if you leave out one of these adjusting entries. And there's a piece in the chapter 3 homework problem that asks you to consider the same thing. So if we leave out an entry, what it means is we're either under or overstating our revenues or expenses. All of our adjusting entries, like every journal entry, will have at least 2 accounts affected. For an adjusting entry, it's going to be one income statement account, so it's a revenue or expense, and one balance sheet account, so that would be an asset or a liability that's impacted. And so if we leave one out, it means that we are not correctly stating either our revenues or our expenses. It's going to under or overstate our income, and on the balance sheet, it's going to under or overstate an asset or a liability. Exercise 3 was a similar exercise to 2, again, asking you to consider what would happen if we just left this out? Why does it matter? And so again, it's asking you to consider the impact on our financial statements and their accuracy. In exercise 5, you were asked to do adjusting entries from the trial balances, and this exercise actually does not even require that you understand why we were doing these entries, but instead you were asked to scan down the columns between the unadjusted and the adjusted trial balance. And for example, here with accounts receivable, the unadjusted balance was $38 debit, and the adjusted balance was a $44 debit. So what happened? We debited accounts receivable $6. So in the first transaction, you would have simply written accounts receivable debit of $6. And then you need to find the other half of that. You need to find the credit side. So why would our accounts receivable go up with an adjusting entry? Because we billed some customers that we hadn't previously billed. Why would we bill customers? Because we performed a service or delivered a product to them. And so that's probably a revenue account. And as we go down here to fees earned, the revenue account, you can see it also went up by $6. And so the credit side would be to fees earned for $6. And so that's all you needed to do for this exercise. And you really, for this exercise, don't even need to know why we did those. You're just finding the accounts that changed and putting that into journal form. And so for today, unless someone has a question that you have not yet asked. Yep.
I noticed that what happened to all of them?
So you're saying some accounts weren't adjusted?
Yeah.
Yeah.
Like, filling them in. But then like, no, it was like, the whole bill was gone.
So do you mean like this account wasn't adjusted and this account wasn't adjusted? Is that what you're saying? Yeah.
I know that I did have questions about it. So I just. figured it out.
Yeah.
Like,
Yeah,
but I
so-
don't know why I got the answer.
Okay, so not every, I think this is the question you're asking. Not every account gets adjusted. And so it's
So it's-
very reasonable. And let me just point this
Right,
out. So
like all the
CAT,
wages and stuff.
yeah, so cash is never adjusted. Never, ever, never, ever, ever is cash adjusted. Either we have it or we don't. And when we have it, we record it. And when we, we can't record, oh, we should have received some extra cash. Doesn't work that way. So, yeah, in land, isn't adjusted. The equipment, the original cost of the equipment isn't adjusted. But you'll notice that the accumulated depreciation is adjusted. And the other side of that is this depreciation expense down here. So I think that's what you're asking about. Why didn't we do every account? And the answer is just because not every account needs to be adjusted. Do you think that's? Okay. But as we start then with exercise 6, we're going to be looking at specific scenarios that are very routine or regular adjustments that most companies will need to make. As I've said in a previous class, we can't possibly cover every possible scenario for every single company that's out there. And so our focus during class is on really the generalities of how do most companies do these things, or what affects the majority of companies. And that's definitely going to be the case with the specific examples we cover in these next few exercises. So the very first one that's a new exercise for us today is exercise 6. And you can see the title of this exercise is Adjusting Entries for Accrued Salaries. So what does it mean if we accrue a salary? As I already said, an accrual means that we're pulling something into the current period, even though the cash isn't going to change hands until maybe next month or next quarter or even next year. So we're getting something into our books that otherwise wouldn't appear there. I assume that most of you in this classroom have had a job before. If you haven't, that's okay. Think about a job that you have had. When do you get paid? Or when did you get paid? Anyone? Every Friday? Every Friday. Okay. And that's the case for this company in this exercise. Anyone else? Every Monday? I get paid every other Friday. Some jobs pay twice a month. So it might be the 1st and the 15th. I think at least it used to be the military paid on the 1st and the 15th. Some jobs will pay the 15th and the last day of the month. You could get paid every other Tuesday. You know, there's all sorts. You could get paid once a month, 1st of the month. Like if you are on a retirement income or Social Security or something like that, you probably get paid the 1st of the month. So the situation here is that the company pays their employees on Fridays. And it tells us in letter A, assume that the accounting period ends on Monday. And so what would that look like? Let me get my annotate tool up here. So we've got Monday, Tuesday, Wednesday, Thursday, and Friday. Okay. Our employees work 5 days and they earn 5 days worth of pay, and then we pay them on Friday. So they tell us here, Stenberg Realty Company pays weekly salaries of $18,500 on Friday for that 5-day work week. So how much are our employees earning per day? Did somebody say it? Thank you. And so we found that 3,700 per day by taking the total for the week and dividing by the 5-day work week. Excuse me. It says that these are salaries. So just in case you are not clear on what that means, salary versus wages. Salary means you earn the same every week, every pay period, regardless of whether you work 50 hours that week or 20 hours that week, you get paid the same. You don't get paid overtime. Yeah, there is a narrow band of people who might be salaried and get paid overtime. We're not talking about that. There is a statutory amount. If you make less than that amount, you have to be paid overtime for more than 40 or be compensated for over 40 hours a week. So in this case, again, they're earning $3,700 a day because it's salary. Wages would mean you get paid by the hour. So on a day that you work 10 hours, you might get paid 8 hours of straight time and 2 hours of time and a half for overtime. And so it wouldn't be the same every pay period. Letter A says journalize the necessary adjusting entry at the end of the accounting period, assuming that the period ends on Monday. And so on for our pay period, we are still going to pay our employees the $18,500 that they have earned on Friday. But our accounting period ends on Monday. So Monday's the last day of the month, let's say. Well, because of the matching principle, the idea that we need to record the revenues we earned in that period and then match against them the expenses, the cost of having our employees work on Monday really belongs in the period that ends on Monday, right? That expense belongs in that period. And then Tuesday through Friday belongs in the next period. So those of you who've had a job, have you ever had your employer come to you and say, I'm just going to pay you early because it's the end of the month? Has that ever happened? It's never happened to me either. Be kind of neat. Oh, great, cool. Pay me early. But no, I think I've had one person in all my years of teaching accounting and phrasing that question. I've had one person who said, yeah, he did actually get paid early once because it was a small company and the boss just really wanted to close out the books for that year or whatever and make it cleaner. But one person in 20 years is not very frequent, and it's never happened to me. So as we look at this, as we think about this, if we recognize that, hey, Monday's expense, $3,700 for Monday, belongs in that period that ended on Monday, what do we need to do to get it there? Well, we need to record salaries expense of $3,700. It's an expense. It has a normal debit balance. To increase that, we need to debit salaries expense $3,700. Now, in my brief review at the beginning of class, just a few minutes ago, I said an adjusting entry is always going to include one balance sheet and one income statement account. So we have the income statement account here. We have the expense. So we're looking for a balance sheet account. So because we have this nice drop-down menu here, it's somewhat easy for us to pick the account that would also be affected by this adjusting entry. And that would be salaries payable. I just heard somebody say it. So payable is a liability. What are we saying? Our employees worked for us on Monday. We're going to record the cost on our income statement, and on our balance sheet, we're going to report that we owe them that amount. We're not going to pay them early, but we do owe them that. Even if Monday was their last day of work, we still owe them for the work they performed on Monday. Even if they don't come back to work on Tuesday, we still owe them the $3,700 that they earned on Monday. And so here's our first adjusting entry. We increase the expense and we increase the liability on the balance sheet. Does that make sense to everybody? Is there anyone who wants to ask a question about that? Okay. So for part B, it changes one assumption. It says, okay, instead of ending on Monday, let's pretend it ended on Thursday. Try that one on your own. See what you get. Instead of ending on Monday, it ends on Thursday. And so it's the same accounts that are affected. But instead of accruing just 1 day worth of salary, we're accruing 4 days. So 4 times $3,700. Same accounts, different amount. So now what do we do? What would happen for this company next? Now, goes beyond what the exercise asks us to do, but I just want to quickly explain what would happen. So we talked about, before I was gone, we talked about the concept of temporary and permanent accounts. And so you should know that the temporary accounts, which are dividends, revenues, and expenses, get closed. They get zeroed out at the end of the month. And in just a couple more classes, we'll see how we do that. Might even be Thursday. So how do we close out those accounts? We zero them out. So looking at these accounts that we have in this adjusting entry, salaries expense is a temporary account. Our adjusting entries are always going to have one temporary account, that's the income statement account, and one permanent account, that's the one on the balance sheet. You'll notice as we go through this that they appear in pairs. There's a clear relationship, a clear connection between salary expense and salaries payable. They go together, right? We incur expense, now we owe our employees. You'll see that on every one of these exercises that we do, that there's a clear pairing or connection for these accounts. So at the end of this month, when we record that salaries expense, I'm looking at letter A, of $3,700, that then gets rolled into our net income and added to retained earnings. The salaries expense account gets zeroed out, but the salaries payable is a permanent account. It's a liability and it carries forward. Just because it's a new month doesn't mean that we no longer owe our employees. Just imagine how well that would go over when payday comes on Friday and your employee says, well, we're only paying you though for Tuesday through Friday because Monday, that was last month. No, of course, they're still going to pay you for Monday, even though it was last month. They still owe you that amount. And so on Friday, when they record the payment of the salaries, they're going to pay the full $18,500. But the expense for the next month is only going to be $14,800, the 4 days that you worked in that month. And then the other $3,700 is going to zero out or cancel out that salaries payable because they're no longer going to owe you that amount. And so the entry would look something like, if I were to, whoops, the entry would look something like this. I can just sneak it in here. So on Friday, when they pay, it would look like this: salaries expense, and it would be the $14,800 for the 4 days. We would debit the salaries payable for the $3,700 because we don't owe that anymore. And the credit cash would be for the full salaries, $18,500. And so in the next month, we would include only the first 4 days, Tuesday through Friday, as expense in the next month, because Monday's expense belonged to last month. Questions before we move on? So you can see that this kind of a scenario would affect most companies. For companies that only pay once a month, they may not have to do that kind of accrual. For companies that pay 15th and the last day of the month, they wouldn't have the same kind of accrual. But everyone in here who answered my question about when do you get paid was based on the day of the week, Monday, Tuesday, Thursday, Friday, whatever. It wasn't based on the calendar of the month. It wasn't because it was the last day of the month or the first day of the month. It was based on the day of the week. And as obviously know, every month doesn't end on the same day of the week. We don't have 28-day months every month. Let's get our green check marks in there and we'll keep moving. So supplies. Supplies, you will recall, supplies are materials that are used up in the normal course of running our business, but they don't become part of the cost of the product. Okay, so we're not selling them to our customers. They're not inventory. They're not raw materials that get incorporated into the making of our product, but they are things that get used up. So things like, just looking around the classroom here, paper that's in the printers over there, whiteboard markers, dry erase markers that might get used, or Post-it notes. For a company like a grocery store, the cash register tape, any ink for printers, things like that represent supplies. Well, in the grand scheme of things, supplies are usually a pretty small dollar amount. That is, it's not a material amount. It's not big enough that we have to really get worried about it. So for example, I use a lot of Post-it notes. And if I need Post-it notes and I'm in my office, I go to where the supplies are kept and I just take a pad of Post-it notes. I don't write it down. I don't have to tell anybody. Nobody does a journal entry to reflect that I just took a 37-cent pad of Post-it notes. Nobody's keeping track of that. And so supplies for most companies are handled a little bit differently than maybe other types of expenses that are tracked more carefully and more rigorously. Excuse me. So as usual, I'm going to take this exercise a little bit farther than what's strictly required for answering the question, just to make sure we can see what's really happening for this company. So it tells us what the balance in the supplies account was, but I want to show you how that balance got there in the first place. So I'm setting up three T accounts here. One is cash, one is supplies, and the third is supplies expense. So clearly there's a relationship between the supplies account, which is an asset, and the supplies expense account, which is an expense account. The first one I labeled cash or AP, which stands for accounts payable, because I don't know exactly how we're going to pay for these supplies, but if it's a small amount, we might pay cash for it. If it's a large amount, we might just have them bill us. And so it tells us the balance in the supplies account before we do anything to it, before we make an adjustment. The balance is $51.75. So I wanted to show you how that got there. So I'm going to assume that we purchased $5,175 worth of supplies. And when we purchased them, we added them or debited them to the supplies account. Supplies are an asset, normal debit balance. So when we debit that account, we're increasing that account. And as always, our transaction needs a credit side. And so the credit would be to cash or accounts payable, however we paid for it. And I just don't know. Okay. So that's how the $5,175 worth of supplies got in there. That's where that ending balance came from. It represents all the supplies that maybe we started with at the beginning of the year, plus every time we bought more supplies, we simply add them to the supplies account. And as I've already explained, nobody's keeping track of when we use up the supplies. Nobody's doing a separate journal entry to show that Professor Hines took a 37-cent pad of Post-it notes. We better adjust that account. We better record that transaction. Instead, what happens, it says, we get to the end of the year and our supplies account on our general ledger shows $5,175, but turns out we only actually have on hand this amount, 615. Well, what happened to the rest of the supplies? We had 5175 and it turns out we now only have 615. What happened to them? People like me used a lot of Post-it notes, dry erase markers, paper for the copier, toner for the copier, whatever. They've been used up and nobody's been keeping track of it. So how do we know that there is only $615 worth of supplies left? Where did that number come from, do you think? How do we know that $615, do you think? If someone here at JCC wanted to know how much we had left in supplies, what do you think they'd do? Exactly. They'd go look at that supplies closet and say, what do we have? Or maybe there's some kind of a warehouse mail room kind of thing where they keep all the supplies, and they would just go look at it and count it up and assign a value to it. The reason they know that is because someone went around and counted it and assigned a value, took an inventory of the supplies that we had. There's one other way they could, and I'm putting this in quotations, they could know. And that is, maybe they don't know for sure, but they estimate it. Could be that they estimate. And why would that be okay? Because I already said, this is a pretty small dollar amount compared to the rest of the organization. It's not material. So it may be that they decide, you know what, it's really not worth anyone's time and effort to go around to all of the little supply cabinets, supply closets all over all 3 locations and count up what we have and figure out how much each pad of Post-it notes is worth. So let's just estimate. And that would be okay too, when it's such a small dollar amount. But what we are told then is at the end of the period, when we get to the adjustment period, we look at our trial balance and we see 5175 in the supplies account, but we know or have estimated that it really should be only $615. So you tell me, what do we need to do to fix that? How do we get the supplies account to show only the 615 that we know should be in there? What do you think? What do we have to do to that account? Okay, so we subtract. So 5175 minus 615 is 4560. We have 4560 more in that supplies account than we should have in there. So how do we get it out? What's the journal entry we need to make? What do we need to debit or credit that supplies account? Credit. We need to credit the supplies account. And the amount we need to credit is that 4560. If we credit 4560 to that account, it brings the balance down to 615. So what I want you to notice is the entry we made is the change we need to make to that account. The 5175 was already in there. We don't make an entry for 615. The entry is the change we want to make. So there was too much in there. How much do we want to take out? 4560. So what happened to those supplies again? Someone used them up, right? So at the time they get used up, it becomes an expense for us. So the other side of that transaction is a debit to supplies expense. And now we have both halves, both parts. So we're going to debit supplies expense for the amount that we used up and a credit to the supplies account because we no longer have those. So we need to reduce the amount that's on our balance sheet. We just brought down our assets by 4560. At the same time, we brought our income down by 4560 because we recorded that expense. If we had left that out, what would have happened? And this goes back to exercises, I think it was 2, 3, and 4. 2, 3, and 4 that I asked you to do on your own. If we left out that entry, we would be understating our expense, which means we're overstating our income and therefore overstating our retained earnings when we close our accounts. And at the same time, we'd be overstating our assets because we're showing more supplies than we actually have. So that can be a big deal because the information we're presenting to our decision makers, the people trying to use our financial statements, wouldn't be accurate. Overstating our income, overstating our equity, overstating our assets. None of that is a fair picture of what's actually happening in our company. Questions before we move on? So one thing I should say, again, you should have seen this in the video already, but one thing that I need to point out is these adjusting entries are not transactions. The transaction really occurred every time someone took a pad of Post-it notes or a ream of paper for the copier. The adjusting entry is to look at what's on our records and make sure it's accurate and fix where we see differences. Okay. Let's talk about prepaid insurance. So prepaid insurance is similar to prepaid rent. These and other prepaid expenses we might have, where we pay in advance for something, but we don't want to record all of the expense all at once because this something is going to benefit us over a period of time. So it might be that we pay our insurance for 6 months at a time because maybe we get a deal that way. Maybe we get some kind of a discount for paying up front. Rent might be the same thing. We might pay our rent for 6 months or a year at a time so that we get the, the assurance that our rent's not going to increase during that time, maybe. So again, I want to add a little bit to what's already in this exercise. So let me put a T account here. For the prepaid insurance. So prepaid insurance is an asset. We have paid in advance for our insurance or our rent or whatever other prepaid expense. It's an asset. It's on our balance sheet as an asset because it's something that's going to benefit us in the future. It's going to help us run our business in the future. So this is an asset. It has a normal debit balance. So when it tells us the balance in the account before we do any adjustment is $22,500, that would be a debit balance of $22,500. Well, how did that get in there? We paid for one or more insurance policies up front. So we would have debited prepaid insurance and the credit would be to cash as we paid for that prepaid insurance. And now time goes on. And so some of those insurance policies, it could be more than one. Some of those insurance policies are lapsing. Some of those, certainly as time passes, we benefit during that period from being protected by the insurance, by having the insurance available. Even if we don't have a claim, we're incurring the expense of having that insurance to protect us in case in the future we need to use it. And so letter A says the amount of insurance expired during the year is $18,000. But our balance sheet right now, our general ledger shows that we have insurance of $22,500. Letter A is telling us, yeah, but most of that has now expired or lapsed. So we have $22,500 in there, but $18,000 of that has expired. So what that means is we need to remove from the prepaid insurance account $18,000 worth of that insurance. We don't have that anymore. That policy has expired, or part of that policy has expired. The part that was for the year that just ended is the part we need to get off our balance sheet. So we want to reduce the asset. So we had 22,500, but 18 of it has lapsed. If we were to put that 18,000, or to put that here, 18,000, then you should be able to see that the balance left in that account would be 4,500. And so our balance sheet at the end of the year after we do the adjustment would show the asset having a lower value, just $4,500. But back up to our entry here, we know that every entry has to have at least one debit and one credit. We know because this is an adjusting entry, we need a balance sheet and an income statement account. This prepaid insurance is the balance sheet account, that's the asset. So what's the income statement account that's going to go along with that? Thank you. Insurance expense. We are assigning the cost of the insurance that protected us during that period. We're assigning the expense to that period. Now, the cash already changed hands back when we bought the policy, which may have been this period, it may have been last year. Maybe we bought a 3-year policy. I have no idea if that exists, but it could. Sure. Okay. So that's one way you could be presented with that information. You could be told that $18,000 of the insurance had expired, and we know that's how much we need to make the entry because that's how much we no longer have. But letter B gives us the information in a little bit different way. It tells us not how much has expired, but how much we still have left. The amount of unexpired insurance applicable to future periods is $4,500. And so what we're being told there is that the balance in this prepaid insurance account should be $4,500 because that's how much we have left. And from there, we would have to figure out how much do we need to remove? How much do we need to credit to that account to make it not 22,500 any longer, but the 4,500 that we should be putting in there. And of course, mathematically, the amount we need to remove is $18,000. If I had made this exercise, I would have made part B be different numbers, just so you know. So we had one more opportunity to practice with this, but whoops, insurance. And so again, the change we need to make to that account is to remove the $18,000 from the prepaid insurance account and move it to the income statement as expense, because that insurance was related to the period that would just ended. I did that to him. Why isn't this letting me click on check my work? Does it? I wonder if it's Cengage or if it's the internet. Hard to know. Well, I'm sure that those are the correct answers. Does anyone have any questions about this exercise? I don't know why it wouldn't let me click on that, but let's move on then to exercise 9. And this is going to take me a little bit longer to explain. Again, I could do this exercise very quickly and just tell you how to do the entry. But I think it's more important that you understand why we do this entry and how the whole concept of long-term assets works on our balance sheet and our income statement. So I'm going to put a bunch of T accounts here on the screen. So I need a moment to do that. I'm going to put, oops. Put a bunch, come on. I'm going to put a bunch of T accounts here. About 5. I think 5 will do it. And I'm going to talk you through an example. So this entry is related to depreciation on equipment. So let's see. The accounts I'm going to need are cash or accounts payable. I'm just going to label that cash. I'm going to put equipment here. And then maybe I only needed 4. Depreciation expense. And accumulated depreciation. Yeah, I might only need 4 accounts. Can't think of another one I need at the moment. So this tells us how much the depreciation is for the current year. But let's think about this equipment. Give me 2 seconds here to do a little bit of math. Okay, so I am going to walk this scenario back a little bit. We're going to start earlier than we're recording depreciation. Because right now, our balance in these T accounts, our balance sheet doesn't show that we even own any equipment. So I'm going to pretend that we purchased some equipment. And I'm just making up this number. It's not included in the exercise. I'm making some assumptions and I will explain what they are in a minute. So please do not get too worried about where this number comes from. So I am going to pretend that we just purchased $666,900 worth of equipment. And apparently we're pretty flush because we pay cash for that equipment. And so at the time that we buy the equipment, it looks like that. Debit to the equipment account, credit to cash. Both of those are balance sheet accounts, right? Buying equipment doesn't help us make any money. Buying equipment does not help us make any money. It's using the equipment that helps us make money. Everyone agree with that? Buying equipment didn't help us make any money. So if we think about our definition of an expense, it's something that helps us to generate revenues. It's a cost that helps us to generate revenues. Well, buying the equipment didn't help us make money. It's using the equipment. Equipment is what we call a long-term asset. And if you look ahead in your book or on our syllabus, you will notice that chapter 9 is called long-term assets. So you can expect when we get to chapter 9, several weeks from now, we're going to talk even more about this. But I just want to give you kind of the setup so that you understand what's going on, so that you understand what depreciation is. So again, buying equipment doesn't help us make money. Using equipment helps us make money. Equipment is a long-term asset. What that means is it's going to benefit us. It's going to help us make money for more than one period, more than 1 year. Now, I just made an assumption when I was doing my math over here. I just made an assumption about something called the estimated useful life. So when we buy equipment, we must, part of the process, we must estimate how long we're going to use it, how long it's going to benefit our company. And I just made an assumption that, because I needed to come up with something, that we were going to use this equipment for 10 years. So that's an estimate. I don't know exactly. It might be that we end up using it for only 8 years and replacing it. It might be that we use it for 20 years. But the accounting rules require us to upfront decide How long do we think we're going to use this piece of equipment? There's one other thing we have to estimate as well, and it's called the residual value. What did I estimate for the residual value? $4,000. So I just made up this number. It's not included in the exercise. I just needed a number to work with. So we have to estimate when we are done using this equipment, how much is it going to be worth? And I just said, $4,000. Just made that up so that I could explain this to you. So we know how much the equipment cost because we paid whoever sold it to us. And we have a journal entry in our T accounts that shows that. Debit to equipment, credit to cash for $666,900. Okay. But so we know that that's a hard number. It's solid. We have an invoice. We can show our auditors. Here's why we recorded the income at that value, because that's how much we paid for it. In chapter 9, we'll talk about where did that number come from, what other kinds of costs might go in there, things like transportation and taxes and setup and training and whatever else. And that's fine. We must estimate how long we're going to use it and how much it's going to be worth at the end of that time. And obviously there's a relationship between those two things, right? The longer you use it, probably the less it's going to be worth when you're done. Residual value has some other names that you might hear: salvage value, trade-in value, scrap value. But what it means is how much it's going to be worth, do we think, when we're done using it. So there are a few different ways of calculating depreciation. I'm just going to show you one now, but again, when we get to chapter 9, we'll cover a couple others. I'm going to show you the simplest one just so you can see how this works. So we paid $666,900 for this equipment. And we expect it to be worth $4,000 when we're done using it. So that means that we are going to use up $662,900 worth of the equipment. That's called the depreciable cost. You don't need to know that term for right now. That's how much of the value of this equipment we're going to use up. And then we're going to sell it maybe at the end of the 10 years and get the other $4,000 back. Okay, so we're going to use up $662,900. Everyone with me so far? Okay. The type of depreciation I'm showing you is called straight line depreciation. It's the easiest one because it means we record the depreciation as the same amount every year. So if I think I'm going to use this equipment for 10 years, then each year I'm going to record $66,290 each year for 10 years. And you'll notice that the reason I had to do a little bit of math first is to make sure that I match this number right here, right? So I had to match the number that they gave us. Everybody good so far? Again, I just made up the 10 years. I just made up the 4,000 so I could explain how this works. Don't worry about that. So now you know where that $66,290 worth of depreciation each year comes from. It's the upfront cost of the asset minus the part that we think we're going to get back when we sell it at the end. We know that we have to take a total of $662,900. That's the value of this equipment that we are going to use up as we use it to run our business. That's the total amount of depreciation we need to record over the 10 years that we expect to use it. Because it doesn't benefit it for just 1 year. we don't want to show the whole 600,000 as expense in 1 year and then no expense for the next 9 years. That would make us look really bad at the time that we bought the equipment and then look better than we actually are for the next 9 years. If we used cash basis accounting, that's exactly what we would do though. Because we paid cash for the equipment, we would record the whole expense up front and we'd look terrible. And then the next 9 years, we'd look really, really good by comparison. But GAAP, generally accepted accounting principles, does not allow that. Say, no, you have to make a reasonable attempt to match your revenues with the expenses that actually help. So if we're using this equipment for 10 years, we need to spread that expense over the 10 years. As I said, this is the easiest way to do it. You just record 1/10 of it every year for the 10 years. In chapter 9, we'll learn 2 other ways of doing that, where it's spread not evenly like that. You don't have, again, don't need to be worried about that for today, but we will come back to that in chapter 9. And so what do? Each year, and I'm saying year because this says for the current year, but some companies may record their depreciation on a monthly basis. Certainly, they're estimating depreciation on a quarterly basis for publicly traded companies so that their financial statements that are shared with the public on a quarterly basis are at least close to accurate. And so the way we do that entry is to record depreciation expense as the debit. And the credit is to accumulated depreciation. So every depreciation entry is going to include a debit to the expense and a credit to accumulated depreciation. And the dollar amount was already given to us for this exercise, but I've now given you one just brief explanation of where that may have come from. A couple comments, and this will take us into the next exercise. Accumulated depreciation is a special kind of account that we have not yet seen. This is the first time we are seeing this type of account. And it is called, I'll label it here. It is called a contra asset. So we know what an asset is. The term contra, the prefix contra means against. So if you contradict someone, you speak against them. If you are contrary, it means that you are, disagreeing with people, right? So contra asset means it goes against the asset. So this is our first year of depreciation, $66,290. And so right now, on our balance sheet, if we were to produce our balance sheet, and if we could see enough detail, this is what we would see. We would see the equipment at what we paid for it. We call that historical cost. So we can see the full value, the original value of that equipment. But I have to squeeze this in a little bit. But then we would see the accumulated depreciation. Oops, 66,290. And we might even put parentheses around that to show that it's negative. And so on our balance sheet, again, we can see how much we paid for it. We can see the amount we have used up or recorded as expense. 1 second here to subtract. And we can see the amount that is left. And that amount that is left is known as the book value. So I wrote BV there for book value. And sometimes it's called the carrying value. So we paid $666,000 for this equipment, But in the first year, we recorded or used up $66,000. And so on our books, it's now worth just over 600. That 600 is not meant to be the fair market value or FMV. It does not mean that we could sell this equipment for 600,000. Maybe we can still sell it for 650. Maybe we can only sell it for 550. Depreciation is an accounting technique that takes that upfront cost, the part we're going to use up, and helps us divide that out over the time that we're going to use it. So in this example, it takes this depreciable cost right here, 662.9, takes that depreciable cost and divides it out over the 10 years. It is not an effort to make our asset on the balance sheet show at what it's actually worth on the open market. Could be high, could be low, could be the same, could be, probably not. Because remember, it's based on two estimates, this estimated residual value and the estimated useful life. And chances are we aren't perfect at estimating either one of those things. Questions at this point? So really, we could have covered this exercise in about 2 minutes, but you would have had no idea why we were doing it or what it meant. And so hopefully this explanation that I've added in makes that a little bit more clear to you what it is that we are doing. The contra asset accumulated depreciation goes against the asset equipment, and we can always see, if we can see enough detail, we can always see how much we paid for it and how much of that we have already recorded as expense, and then what's left. Okay, the book or carrying value. Questions, anyone, before we move on to our last exercise for today? And as I said, covering that leads us into our final exercise here, where we're asked, what is the book value of this equipment? So the balance in the equipment account is $3,150,000. That means that we have purchased a total of $3,150,000 worth of equipment. That's how much we paid for it up front. But we've been using the equipment for a while. And so each accounting period, we record depreciation expense for that equipment, and we add that same amount to the accumulated depreciation contra asset. Because that's a permanent account, it belongs with the assets, but it does have a normal credit balance. It goes against the asset and it keeps accumulating. Everyone, I assume, knows what accumulate means. It keeps adding up, right? And so every time we record more depreciation, we increase that account. And every time we increase that account, we reduce the book value or the carrying value. Again, those two terms mean the same thing. So here it says book value, but it just as easily could have said carrying value there. And so the remaining book or carrying value on this equipment is the difference between what we paid for it and the part that we have already recorded as expense. So the book value in this case, $1,075,000. And I've already really given you the answer to part B. Does the balance in the accumulated depreciation account mean that the equipment's loss of value is $2,075,000? The answer is no. As I said, it's not an effort to make this match fair market value. Doesn't mean we've actually used up $2 million worth of the value. It could be that we've used up more. It could be that we've used up less. Because depreciation is an allocation of the cost, what I refer to as historical cost of that equipment, to the periods benefiting from its use. And back to our example from exercise 9, we're going to use it for 10 years. We need to spread the cost over the 10 years. And there are different ways of spreading that cost. I showed you the simplest one called straight line, where we record the same amount every period, every year. So that is the end of chapter 3. We actually are a few minutes early. Anything else you want to talk about? Any questions? Anything? Yes, thank you for asking. I totally meant to do that when I was talking about the exam earlier. Thank you. So let me, the question in the classroom was, can we talk about the real world annual report? Because because we have our first exam due Sunday, you also have the first installment of your annual report project due Sunday. I have started going through the companies, and I should have those done by the end of the day today, so you'll be able to see if your company was approved. I had hoped to have those done before I was away, but that did not happen. So in Brightspace, these are the only assignments that are submitted in Brightspace. As you know, everything else is in CNow, in Cengage, CNow. But the real world annual report is in Brightspace. So most of you, but not all of you, have chosen a company. If you did not choose a company yet, you have maybe another hour. And at that point, if you haven't chosen a company, I will be assigning one to you so that you have a company to use for this weekend. Each chapter in the book, at the end of the chapter, has a section called Take It Further, which are additional work for you to do. So it's just after the exercises and the brief exercises, problems, and then there are the Take It Further questions. So I have snipped a picture out of the book for each one of the chapters. Our exam on Sunday, or due Sunday, covers chapters 1, 2, and 3. So there are required questions for each chapter, 1, 2, and 3, that you need to answer. Ignore where it says teams, any place that says teams. This is an individual project, as you know. What you need to do, so for chapter 1, you can see the questions on the screen right now. In your Word document, you should use Word. If you use a program that I don't have, I can't open your document, and you won't get credit for it. You cannot submit a link to a Google Doc. That is not acceptable. It has to be a static document, meaning it can't be changed. So you need to, if you use Google Docs, that's fine, but you need to download it as a Word document out of Google Docs to submit it. Okay. So this is what you should be doing. For chapter 1, you open a Word doc and brand new Word document and write your name at the top. And then you write chapter 1 and you number 1, 2, 3, 4, 5, 6. And number 1, you don't need to answer in full sentences. Please don't actually answer in full sentences or in paragraphs. That's not necessary. It takes more time and doesn't add any value to what you're doing here. So your answer to number 1 would just be the name of your company. Maybe it's Starbucks Inc. or whatever company you have chosen and had approved or that I assigned to you. Number 2, Redmond, Washington, or wherever. Number 3, name of the CEO. Okay. Answer all 6 questions for chapter 1. And then you're going to pull up the instructions for chapter 2. Again, I just snipped them out of the book to make it easier for you, but these are all right in your book as well. So after you answer questions 1 through 6 for chapter 1, you're going to skip a space and then write chapter 2, number 1 through 6, and just answer the questions. For these, and I've mentioned this earlier in the semester, where it says what amount of total assets, keep in mind that your company I can almost guarantee that your company is expressing the numbers on their financial statements in thousands or even in millions. So you need to use the label. You need to put the dollar sign. You need to write if it's in thousands or millions. I can almost guarantee your company doesn't just have $27 million worth of assets. That would be a really small company to be publicly traded. Almost positive that's not the case. So again, chapter 2, 1 through 6. And then finally, chapter 3, I don't know how many questions there are. Maybe there are also 6. So chapter 3, 1, A, B, C, D, E, 2, and then you've answered all of your questions. And then you just come to this drop box. And to submit, if you've never submitted something in Blackboard or in Brightspace, click on that drop box where it says add attachments. You're just going to browse just like you would attach a file to an email or anything else. You're going to browse and find where you saved it. Please make sure you hit save before you attach it. Okay, that happens sometimes. People are working, they don't hit save when they finish, and so they're submitting an incomplete project. Okay, does that help with what you need to do for the project? In every single exam, there's a piece of the project that you will submit. The project is not intended to be done in the time limit you have on the exam. Please don't try to do that to yourself. The exam is separate. You can do this project today. Maybe some of you have already started it. I suggested that at the beginning of the semester. For some people, they find it easier to, we did chapter 1 in class, now do chapter 1 of the project, and then just add to it. What you submit this week is going to be just chapters 1, 2, and 3. What you submit for our next exam in a few more weeks is only going to be chapters 4, 5, 6. You don't need to keep resubmitting the earlier chapters. You should be submitting only the chapters that are on that exam. Again, in a Word document, you can get, if you don't have Word, you can get Word for free from Office 365 using your JCC email address. If you don't know how to do that, let me know and I will find the link for you, but it's free. There's no reason not to use it. If you choose to use Google Drive, that's fine. It has a download as Word option. Make sure you do that. If you submit a link to a Google Drive, you get 0 credit. And I know you all know why. So anything else you want to ask about or talk about? Still a few minutes early, but not as early as we were. All right, well, I'm going to stop the recording for today. Thank you all for being here.